Fed launches aggressive rate cuts, melt up to continue. So if you don't know, obviously, yesterday the Feds cut the interest rate by 25 basis points, which, I don't know, man. I'm really falling out with this whole idea of just the money. It's just so boring, man, and exhausting. And then it's like we have to deal with all this BS. And none of the data even really matters. It's just exhausting. So really, I'm not gonna lie, I'm probably not gonna be uploading as much, but we will check this out because I want to know, actually.
The Federal Reserve meeting concluded today, and this is wild. So they cut interest rates today, but that's not the wild part. That was the expectation. So the wild part is that they are on a policy path of aggressive rate cuts. So that means more easy money and higher inflation. So first, I want to show you the projections for the rest of the year, and then I want to show you the highlights of the press conference. So here's the updated SEP, the Summary of Economic Projections. Now, the last time the Federal Reserve gave their projections was back in June. They projected that the economy will grow at a rate of 1.4% this year. Now they revised it upwards to 1.6%. In June, they projected that the unemployment rate would end this year, so 2025, at 4.5%. They left that projection unchanged at 4.5%. So currently it's at 4.3%. So it is expected that the labor market's going to continue to weaken for the remainder of the year. Now, the Federal Reserve's preferred measure of inflation is PCE inflation. So they like this one better than CPI inflation. In June, they projected that the rate of inflation would end the year at 3.0%. That forecast remains unchanged as well. So right now, PCE inflation is at 2.6%. Therefore, they expect that the rate of inflation is actually going to accelerate for the rest of the year. But within PCE inflation, they like to look at core PCE inflation. In June, they projected that it's going to end the year at 3.1%. So that also has remained unchanged. Right now, core PCE inflation is at 2.9%. So again, they expect that inflation is going to get worse when looking at this metric as well. So it's going to get worse before it gets better. Now, here's the most important item, the Fed funds interest rates. So here's what you need to know. There are 2 more Fed meetings left this year. There's going to be the next one in October and then the final one in December. Based on the June forecast, their expectation was that there's going to be 1 more interest rate cuts this year. But based on this updated forecast, their new expectation is that they're going to cut interest rates in October and in December. So there's going to be 2 more rate cuts this year. So they plan on cutting interest rates more aggressively because they're concerned about the labor markets. Now, let's see if the market believes whether this is going to happen or not, or if the market's skeptical. Now, this is according to the CME Fed Watch tool. Before today's information, there was a 65.9% chance that there would be 2 more rate cuts this year. And after today's new information, the odds of a rate cut happening in October and in December, so 2 more rate cuts.
I'm just wondering, is all this nonsense, right? Is it actually going to equate to the economy getting better? And the answer is no. For 95% of people, this will be damaging to the economy. For the very few who have some assets and who have enough of it, they'll be fine. But will they in the long term? I guess we'll have to see, but it's just so BS, man. This is so just lame, boring. I don't know, man. I'm tired of listening to this because it's so annoying that these people can just destroy the economy and then be like, we'll just wait on the data to see the progress. Like, I'm tired of tuning in. It's all just BS, man.
Has increased from 65.9% to 82.6%. So in other words, the market does believe or has more confidence of this situation playing out. Now, I want to show you the highlights of the press conference. In this video clip, a reporter asks, okay, so why are you cutting interest rates if the rate of inflation is actually accelerating? And Powell says because their focus is now more on the labor markets than it is on inflation because they have the dual mandate. So please take a look.
Looking The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed.
And look at the wording, softened. It's all these that's why, honestly, I'm going to be honest with you. I don't care what statistic you give me about most things. I really don't believe you, because it can always be manipulated. It can always be geared towards something. And I just don't believe you anymore. I'm being honest. You can be like, oh, hey, there's this statistic that says this and this happened. There may be, and it may be from a reputable place, but honestly, I just don't believe you. So I guess we're all screwed if we're all just gonna interpret things how we want to, but I don't believe you anymore. I don't believe anything.
So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Now, I want to show you this question. So they ask, is a 0.25% interest rate cut actually going to make an impact? And you're going to see Powell say that it's not just about today. It's not just about today's rate cut. It's about the process. And this is just the beginning. So basically, there's more rate cuts to come. So please take a look.
As you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that.
Now, I want to show you this question. This is a very good one. So they ask, are we on a preset course of interest rate cuts, or is this still a meeting by meeting thing? And you're going to see Powell say, and this is what he claims, that we're still on a meeting by meeting basis and we're going to be data dependent. I mean, whether you believe that or not, that's for you to judge, but please take a look.
In the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made.
Now, this is a good one. So the Federal Reserve, in their SEP, their expectation is that PC inflation and core PC inflation is going to be at 3.0% and 3.1% by the end of the year, right? Okay, but the Federal Reserve is saying that their goal is to get inflation down to 2%. But if they're going to end up at those numbers are actually higher than they are right now. So the reporter asks, okay, you're trying to get down to 2%. Is that realistic? If you're saying that, isn't your credibility at risk? And you'll see how Powell responds.
Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Now, in this video clip, the question is, when would...
I feel like, okay, let's be real. If we wanted the economy to really boom again and people to be good, stimulus check to everybody for $5,000, lower the interest rate, there's more, but at least you could at least do that. And I would say lowering by 50 basis points instead of 25 this entire year, and then maybe slowing down in the next years. But they'll never do that because they don't really want to help the economy. Yeah, I don't know. Or keep the interest rates the way they are right now, or do what you're gonna do right now with the 25 basis points and all the other BS, and then give out a stimulus check for $5,000 only to American people that are working, that have a job and stuff, or that were working in 2025, and then make sure inflation doesn't get out of control. But they'll never do that.
The larger rate cuts, like a 0.5% rate cut, be warranted? Because the expectation is that they're going to do smaller cuts at each of the meetings, like 0.25%, 0.25%. So you're going to hear Powell say that they would only do a larger rate cuts if their policy was out of place. So basically, like if it was an emergency situation or if they got it very wrong. But you're going to see Powell say that policy has not been out of place and that they're basically in a good spot. So please take a look.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Now, this is the last question.
I swear, when this country collapses, I don't want to ever hear these dudes. I don't know, they need to be fired or just gone, whatever. I don't know how this system works, but they just all need to go. I'm not going to lie.
I want to show you, and this is a very important one. Okay, so the question is, isn't there a risk that you're cutting interest rates right now when the stock market is at an all-time high? Isn't there a risk of a melt-up, this causing a melt-up? And you're going to see Powell says that he wants financial stability, but right now he believes that the stock market and financial assets are not at elevated levels. I mean, to me, when I hear him say this, well, I believe that he doesn't care. He doesn't care if there's a melt up. And honestly, I believe that the Federal Reserve and the government, they both want to melt up. This is the only path. But you can see for yourself. Take a look.
This rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
You know, we're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, you know, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities.
The truth is, man, we've given these people too much power. Well, I didn't, you know, but, or I guess maybe you didn't either, but somewhere down the line, too much power was given to these people. I know the system's rigged. Everything was stolen and everything is BS in and of its own, but I feel like there was a shift somewhere. Either way, if it all collapses, screw it, who cares? But I guess this is supposed to help the economy, so thank you, Jerome Powell, you cheeky bastard. See you guys in the next video, man. Peace.